Hi, good morning. Good morning, everyone. So just waiting for lots of people to come through, but we'll make a start. So yeah, I'd like to welcome everyone to our Investing in Tin seminar. This is now the 13th year that we've been doing this event in London. So it's nice to see some regular faces at these events as well, people who are already involved in tin, but also good to see people who are more new to the industry. And I hope that today will be a nice introduction to understanding more about the tin industry and why we need so urgently some further investment in new supply. So just some housekeeping to start off. There is a fire alarm test at 11 o'clock scheduled for today, but that should be over relatively quickly and you don't need to respond to that at all. We'd also like to just quickly highlight our new technology theme at ITA. So originally we were a research institute, and since then we've moved more into markets and technology. However, we are going back to technology now, and we do have our technologist, Georgia, who some of you may have met this morning. So we're also working on the Tin Valley Virtual Technology Hub. So this will be a networking space and a space for shared knowledge about new tin technologies. This is a wide range of downstream technologies, but also things like producing metal directly from ore. So we hope that this will be a nice new platform for knowledge sharing and networking. So our first speaker of the day is my colleague Tom Langston, who is the Senior Market Intelligence Analyst at ITA, who is going to give us an introduction to the investment case for tin and set up just quite why we are in a situation where we've got a market deficit for the spice metal, which is tin. Thank you. Over to Tom.
Thank you, Freddie, and good morning, everyone. So, as Freddie says, I'm going to kick off today by giving our investment case for tin, and I'm excited to delve into some of the reasons why today's outlook presents an opportune time to invest in tin. So, our case is built on three key arguments which underscore tin's strong investment potential. One, tin is already an essential metal with existing stable markets. Two, tin demand is set to boom over the next decade, driven by technology and the global energy transition. And three, at the same time, on the supply side, we see existing mines maturing and the new project pipeline is thin. In other words, tin's long-term fundamentals appear incredibly strong. So I'm sure most of us are familiar, but for those that are new to tin, let's just quickly explore the critical roles that tin already plays in our daily lives. Freddie already mentioned that tin is the spice element, and that's because a little is used in a vast array of applications. And you can see here a snapshot of tin's use sectors for 2023. So it is solder, which tin's primary application, which markets tin as the glue that holds together all of the world's electronics. So there's around 2.8 grams of tin in every iPhone. And solder is also integral to consumer goods, such as washing machines and air conditioners. Tin chemicals, tin's second largest use, have over 100 different applications, including as PVC stabilizers, so that's in your pipes, doors and windows. And tin chemicals even find their way into very unique applications such as toothpaste. Tin plate, tin's traditional market, so tin-coated steel used in food and beverage cans, also remains a significant tin use sector, at about just over 10% of global demand. Therefore, despite occasional fluctuations caused by macroeconomic shocks and weaknesses, tins does benefit from stable demand from its existing major markets. In particular, tin significantly benefits from inelastic demand for solder. So there exists no other conductive low melting point element capable to rival tin, which means that tin's major use sector will remain robust to substitution, even under significant price pressure. So that's today, but looking ahead, tin's growing importance should not be overlooked, with it being vital to both the digital and energy transitions. So electric vehicles use twice the amount of tin as ICE vehicles and are projected to account for about 40% of all cars by 2030, more than doubling from today. Tin is already used in lead-acid batteries, which is a sector which has shown strong recent growth, and the global battery capacity is estimated to expand by about 800% by 2027. Then we come to the rising star of tin demand, so tin's use as solder ribbon in solar panels, which has tripled over the past 5 years and will remain a key sector for governments to achieve net zero targets. Digitalization, supported by a growing 5G platform, and the emergence of AI also boosts tin's long-term demand case, uplifting consumption forecasts in chips, computing, and data centers. So here you can see our demand forecast to 2030. So growth, as you can see, strongly driven by technology and those sectors which I just outlined. Some of the investor audience here may be more familiar with the bullish long-term case for copper, and tin shares a similar narrative, tending to trade very closely with copper actually, with both metals benefiting, as I said, from the energy transition and also sharing similar end-use sectors. Another point also to note is that tin's unique technical properties also present further new uses, particularly in green technology and energy storage, with sodium-ion batteries representing just one of many emerging new uses. And at the ITA, we are currently tracking new R&D and new uses for tin. And if you want to learn a little bit more about that, then please speak to Georgia, who you can find later, our new technologist at ITA. Okay, so if we move away from demand and turn our attention to supply and review the current state of supply. So despite the broad global coverage of tin deposits, at present, supply is still highly concentrated with just a few major producers. So 3 countries account for 60% of global mine supply, those being China, followed by Indonesia and Myanmar. While on the refined side, smelting capacity is heavily concentrated in China and Asia, with few countries possessing fully integrated supply chains. About a third of all tin used is recycled, and secondary producers in the US and Europe do provide some cushioning to possible primary supply disruption. However, the market this year has been dominated by supply challenges, which has sharply highlighted the need for a more diversified supply chain, which in turn presents a good investment opportunity. So tin has largely been the standout performer in the base metal sector this year, and this performance has been strongly driven by notable disruptions in Indonesia and Myanmar, the world's second and third largest producers. So we'll just give a quick update on that. So in Indonesia, a licensing overhaul and an ongoing investigation into the country's tin mining sector has resulted in delayed and reduced exports. And overall, we estimate that Indonesian production will be down about 30% this year. Meanwhile, in Myanmar, the Wa mining ban, effective from August last year, remains in place. And the significant stockpile door, which maintained the flow of tin and concentrate to China, is now exhausted, essentially cutting off about 9 to 10% of global mine supply. So these dynamics have increasingly caught the interest of the investment funds in the speculative market this year, which have seen twice surge to a record long positioning on the LME. But also governments are now waking up to this supply chain vulnerability, particularly as we see resource nationalization becoming an increasingly common theme globally. So we recently saw the US, the second largest tin-consuming nation, move to try to increase its own domestic production. Looking forward then, how do we see the global supply landscape evolving? Well, while growing importance will be placed on recycling and secondary production, we only see it increasing modestly to 2030. So mine supply will remain the dominant feedstock. So where will this come from? So I'll briefly go through each region. So we see minimal growth in China and the rest of Asia, with mine supply plateauing to 2040. China is more focused on overseas mine investments, while we also anticipate there to be some decline in Myanmar due to a lack of exploration efforts. Also, mine production is becoming increasingly challenging in Indonesia, with dredging required to go further, deeper and offshore. In South America, we anticipate that supply will be roughly maintained by planned expansions and some new mines, balancing the decline in existing mines. Africa, as I'm sure we're all aware, has been a region of recent strong growth. We have seen output double over the past 5 years, and this has been largely due to expansion in the DRC. However, we anticipate growth in Africa cooling as major mines reach capacity. It is therefore really Australia and Europe which are the regions with the greatest growth potential. In Australia is particularly poised for major growth, with numerous new supply projects already underway and approaching final investment decisions and production. While in Europe, projects in the UK, Spain and Germany look to bring back large-scale mining to Europe. Overall, though, the projected existing mines and probable new mines are not sufficient to reach the forecasted new demand. So we see how that plays out on the market balance. As I said, we see very minimal growth in existing mines to 2030, while currently there are not enough new mines, which are probable. Considering these factors, projecting tin supply and demand shows a tightly balanced recovery and growth cycle to 2027-2028, after which significant calculated deficits emerge, expanding rapidly to 2030 and beyond. Fortunately, and it is important to stress that there is no shortage of tin in the ground, but attention is now swiftly turning to the urgently needed investment which is required to unlock it. So discovered resources total 15 million tonnes, which is enough to last 40 years, while tin reserves are enough to support the current demand levels for 14 years. For comparison, copper reserves will support the copper market for 31 years, so tin is lagging behind. And there are challenges. So the highest grade and largest tin deposits have largely already been exploited, while recovery from existing mines is also becoming more challenging, particularly from Indonesia, as I mentioned. So while smaller deposits and the declining grades do pose a challenge, these should be alleviated by advances in mining methods, improvements in processing, and most excitingly, ore sorting. But the greatest challenge still remains securing the necessary investment. So a little bit more on that. Looking at the capital cost requirements for new mine projects, the ITA estimates that it takes approximately $28,000 to bring on 1 tonne of annual capacity online. This translates to a capital cost requirement of just over $1 billion needed by 2030, and on a yearly basis, that is $228 million. So currently, the market is not close to this target, with investment in tin projects hovering around $50 to $100 million a year. Some tin will also be mined as a co-product and byproduct from tungsten and lithium mining, but this will not be sufficient to meet the required demand. For a substantial increase in capacity, the market needs to actually invest in tin projects rather than rely on other metals bringing tin along. You can see on the chart on the right, investment in junior miners companies in 2024 has been better than last year, but it's still only about a quarter of what is needed to bring new projects online. However, there are some encouraging early signs, and at the ITA, we have seen increased interest from investment funds looking to learn more about tin and explore equity investments. We've particularly seen that this year. And there is plenty of choice. So the ITA's Explorers and Developers Group, highlighted here, represents some of the most promising junior miners around the world, and we look forward to hearing from some of them this morning. In conclusion then, tin is not only an essential metal today, but is a strategic one for the future. Disruptions this year have highlighted the precarious nature of supply and likely foreshadow similar dynamics to follow in the future, especially when we consider tin's robust demand outlook and a thin project pipeline. Despite welcome new interest from investors and governments, which is now coming into the tin space, a broader wake-up to tin is still needed to bridge the supply gap. So if anyone has a spare $1 billion, you're very welcome to spend it here. Thank you.